Good morning, everybody. Welcome back to the Schwab YouTube channel. It's our Wednesday edition of Trader Talk in today's market. I am your host, Kevin Horner. It is a chilly morning here in the Denver metro area today. As usual on a Wednesday, pleased to be joined by my friend, fellow Schwab coach, Mr. Brent Morris. Good morning, Brent. How are we doing today, sir?
Hey, doing good. April Fool's Day, everybody. So just be aware, but good day for me. It's actually raining in the Salt Lake area, which is
Hey.
weird, but happy about that. And I get to be on Trader Talks for the second time this week. So good.
Hey,
good
we
news.
don't mind that all that much. One, we like rain. We need it in this
Yeah.
region, that's for
Yeah.
sure. And two, always good to have you on multiple times in the week, Brent. So thanks for being here as usual. Today, we're joined by Barb Armstrong in the chat. So stop by there, say hey to Barb. She'll get to comments and questions Brent and I are unable to, but you know we're going to keep an eye on things for you. So please feel free to post in the chat for the duration of our show. We'll go about 45 minutes and as usual. Also, remember, if you're not already doing so, to follow us on X. You can find us there, Brent Morris CS, Kevin Horner CS, and Barb Armstrong CS. Try to post for you there throughout the week. Try to give you some charts, some insights as to what might be happening in the market, and we'd love to engage with you there. So a follow and keeping an eye on what we offer you there would be great. So beyond that, make sure you're subscribed to the channel, everybody. That'll help you out and helps us out as well. So let's get to our disclosures and some reminders before we dive into the chart. So first of all, remember that everything we cover for you today should be considered informational and educational. We do not make recommendations nor any endorsement for a specific approach to trading the market. What we will do here, however, is utilize technical analysis as we review the areas of the market. We'll offer up concepts and strategies traders might choose to employ in their own processes. Remember, though, not to make decisions exclusively based on what you get in the way of technical analysis. We discourage you from doing that. And essentially, technicals can be just one decision-making piece for us, but not the entirety of it. Okay. Now, beyond that, we want to remind you of our traditional schedule here, or our agenda, that is. We do a top-down review, so we'll start with the broadest of indices, working our way through those into industry groups, sectors on the move, some material details as well. We may very well hit up precious metals and oil, of course. Oil very important these days, needless to say. And then we'll get to stocks in the news where we can. So before we get to all of it, though, I just want to remind you, you do have the opportunity to meet us in person at any one of our in-person events. We are coming out to the Dallas area for the advanced options coming up in just about 2 weeks. We'll be in Boston the week after, and then a market drive event from Chicago in May. So make sure you're on the calendar there, frequently checking it out. Everybody, get yourself registered. Registration is free, as is attendance. We would love to see you there. Now, with that, Brent, taking a look at the S&P, we had that huge, beautiful green candle.
Yeah.
The best day we've had since April of last year. A fantastic development, Brent. We're looking for some follow-through today.
We are, and it's too early to tell. We're obviously a few minutes into the market day, but it's, when I say possibly 2 up days in a row, you're thinking April Fool's here because the way the market's been. But yesterday was a huge, huge bounce. Does that represent a bottom? I don't know. Part of it's just going to be news driven. The president wanted to make an address tonight at 9 o'clock Eastern time. Obviously regarding, I think, at least the status of the war, and that obviously going to affect the market. It affects oil, which affects the market, and affects everything. And so, we'll see. But that's a strong bounce yesterday. That's about as strong a candle as you get, a big green candle, where we're ending up right near the end, the high of the day.
And again, the thing that I have to remind we all need to do this as traders, obviously, is just to not get bogged down by the most recent piece of information we have to work with. And let's just remember there's a broader trend at play. We have been below the 20-day moving average for going on 5 weeks almost. So, Brent, would you be at all surprised, even if we make higher highs eventually, if we run into that 20-day moving average in orange coming in somewhere in the neighborhood right now of around, let me see if I can put a number to it for you. How about 66.20? If we got to 66.20, Brent, and just took a pause and said, okay, we've made our move back. Let's take a breather and reevaluate what's happening here. Would you be surprised by that?
I would not be surprised, Kevin. We are still in a downtrend. As good as yesterday looked, we've had these lower highs and lower lows. Most recently, about a week ago, 5-6 days ago, something like that, we kind of had a high. We touched that 200-day moving average. I'd like to break above that, which is the high of that is pretty much coincident with our moving averages there. And that would be kind of a first step in breaking the downtrend. Doesn't necessarily mean it's an uptrend at that point, but that would be the first step in breaking the downtrend. Right now, it just looks like a kind of a relief rally, to be very honest at this point. We'll see what's happening, but you can see how big that jump was. Just looking at the RSI at the bottom of the page, we were in the oversold area just a couple days ago. And we're up at 45, 46 right now. So that's a big move up. But the 2 days technicals don't a trend make here, I guess, is what I would say.
And I think that's the takeaway, Brent. We're not trying to throw too much cold water on a relief bounce. We like relief. It's good, but we still need to remain disciplined and stay true to the broader trends here. It is unclear whether the long-range trend is going to maintain. We obviously need to get above the confluence of the 20 and the 200 for that to look like we are back on path. So we'll have to wait and see. We just need more data points, I think, is what many traders are suggesting. So if you're wondering about some levels intra-period, you see where my oval is there. That's on the confluence of the 20 and the 200. So if you're looking up at 66.20, it's going to be right basically in these prior highs. So Brent, if we evaluated this on just this intra-period look, and we're trying to say, hey, in this intraday time frame, we may have made higher highs, it's going to have to basically push us through about 66.40 or 66.50 even, wouldn't it?
That's the level that keeps coming up, whether it's from the price action or from the moving averages, which of course is a result of price action. But we see a convergence of different potential ways of looking at shorter term resistance levels. Well, I don't want to. It looks good for what it is right now. It doesn't mean that's going to last forever. But we just have some nice upward momentum right now in the markets, and it's news driven. We've said that all along, and we'll see what the news is on the markets. And but right now, hey, it's looking strong so far.
We'll take it, because it's been difficult, to say the least. Brent, we should also, since we're talking S&P, I want to bring up my my 3-chart viewpoint. This is going to incorporate futures charts, everybody. So we're looking at the S&P futures on the left, the VIX futures in the middle, and the oil futures on the right. And Brent, what we seem to be looking at is a bit of that new downtrend, short-term albeit, but a downtrend nonetheless in oil. Remember, everybody, these are just future symbols. We're not advocating for futures trading. We're looking at it as a relationship, an understanding of how the barrel price and pushing it back now in crude back below $100 a barrel. That's a very psychological level for us, Brent, but it also reflects the recent downtrend in play with some of the positivity and the positive news with the idea that perhaps the conflict in Iran could actually be nearing an end. Chances are oil could go lower even still.
Oh yeah, it certainly could. I mean, it was reflecting the geopolitical situation. The 100 level is kind of a key level, both on WTI, which is what we have on the chart there, the /CL, and Brent crude, which is still above 100, but it's settled down a little bit, and so that's that's drives the market here partially right now. This is something we've talked about. There's at different times, there's different things that tend to be market drivers. there's been times in the past where like the CPI or inflation reports, when I say the past, a year ago, inflation reports were really driving the market. Right now, oil prices are really driving the market. It doesn't mean every day there's a one-to-one correlation between what oil does and what the SPX does, but in general, they're going to be just inversely related, and we've seen that lately, and we've seen that over the past. This is just a 2-day chart. Past day or so, we've had this pullback in oil, nice run up in the index.
Exactly that. And Brent, at some point, this is going to change as things settle. What we assume is a settling of the conflict. So keep that in mind, everybody. This is not going to be the case perpetually, but it's the elevation, in oil, the risk factor as it relates to our inflation, both domestically as well as globally, and we have to keep an eye on that. That's essentially what's been pressuring our broader market. So I want to make sure that everybody's understanding of that relationship. There will be a change to the relationship from such a short-term basis down the road, I imagine here.
Yes.
Hopefully sooner rather than later, Brent. That would actually be a positive for the broader markets, I would think.
Absolutely. And in terms of like, one of the concerns is the oil's relationship to inflation, no doubt. And inflation can handle the shorter term spike, but elevated spikes for an extended period of time are really going to work on the inflation numbers, which is not good, and can certainly affect the markets as a whole. Now, that's one thing. When we look at inflation numbers, often they'll have like core CPI, and which excludes, it strips out energy or oil and food because it gets to be very volatile. And if you ever want to know what do we mean by volatile, well, you've just lived through it through the last couple months in terms of oil prices, and why often those inflation numbers strip it out, because they can go way up and they can also go way down. Now, we've seen a little bit of a pullback, not that much of a pullback yet. Hopefully we see a bigger pullback in the next few weeks.
Yeah, it would certainly be beneficial for all of the broad market indices here. We have skipped over to the NASDAQ 100. I just wanted to highlight quickly how to utilize this, everybody. By the way, when you take that link, that grid that I shared with all of you, first of all, just go ahead and reload that. You basically copy it. Don't click it. Copy the coding of the grid there. Place that into the setup here. So you click on the gear setup, open shared item, and then paste it right here, hit preview, and then import, and it's going to launch that grid separate. Once it's launched, it becomes a savable grid. So I'd encourage you to title it, save it, make it easy to locate under your grid drop-down menu here, like so. And this is where it would appear. Okay, so Brent, watching the NASDAQ, you can see that I've got that double top drawn in, the neckline of the double top, and it's red because we spent just the last 4 sessions beneath it. Brent, we are right back to it. This is a bit of a tricky spot because, again, traders were looking always for confirmation of, hey, have we moved through a new level? Well, some traders are going to say, we need more than 1 day above the red line to kind of invalidate this level as resistance. It could be a bit before we get that. Maybe we hold it today, maybe we don't, but this is an important level nonetheless.
That is an important level. The traditional interpretation of that double top would be, traders would be looking as a potential target down. Probably looks like you drew that lower white line there as a potential target on that. And this kind of shows, hey, look, whatever your price pattern targets are, they're not guarantees. We don't know what's going to happen. And so if you're a bear, what you see is, hey, a retracement back up to what was a support line could potentially now be a resistance line. Well, we're right there. We're right in the precipice of this. Are we going to stay above it, or are we going to use this as a rejection point and bounce back down? As you mentioned, the jury's kind of out. And that's why a lot of people will say, well, I need it to be a couple days, a couple days above or below. Well, even that, there's no guarantee. We've been below that support line for a couple days. And now it's bouncing back up, and so it's a way to keep you humble um, in terms of your technical analysis there on that. But you're right, that is a key level.
One thing I know, Brent, is that the market, the moment I start feeling smart, is the moment I will be humbled by the market. That is almost unequivocal. Now, Brent, we talked about this on Monday. The look at, if I put just the 20-day on here, everybody, Wiley loves to bring up the so-called Horner rule, the reminder that we all need to define confirmation for ourselves. And on Monday, we talked about the instances getting us into and even through the 20-day intraday, even closing above it a couple of times, Brent, but each time getting pushed lower. This basically reminds us that even though we may run into the 20, we may even close above the 20. In volatile markets, we shouldn't be surprised to get 1 or 2 days closing above it. So this is where, once more, defining our level of what we need for confirmation to validate a new potential bullish trend, we need to define that for ourselves. For the trader who said all along the way, 2 days above 20-day moving average is reason for me to go long, they would have been wrong thus far. That doesn't mean it's not going to change, but we need to know those little tidbits, don't we, so that we can actually redeploy money. We can feel comfortable redeploying money and setting risk differently. It's a big process for a trader.
It is an important process too, because these levels aren't guarantees of turnarounds. They're not a crystal ball for the future, but they are a systematic approach that you can use in your trading when you're deciding on that. And you can kind of, when we say systematic, we mean it's more of a system in a sense. It's a little bit more objective and not emotionally driven. By setting levels, you can reduce. You'll still probably have some internal churning, but you can reduce the emotion that you're feeling when you're doing this, and that usually leads to better trading decisions there.
Well, that's really it, isn't it? It's the more we can make our decisions based on factors that do not incorporate our emotions, the better off we're going to be. A little bit more black and white. It's also one of the key reasons that traders do consider planning their trades out, right? Thinking about it in advance. Here's what I think could be happening. Here's what I think could happen further. Here's what happens if I'm wrong. And here's where I make a decision on that I was wrong. I'm going to take this action now. Having all of that thought process in advance is just one way to kind of work to reduce the emotional tie to the trade. Doesn't mean it's going to be easy for us, but nonetheless, it's a step we have to try and take. Brent, we're getting a good little bounce out of the Russell. In fact, the candle on the Russell yesterday was really nice as well. Very reminiscent of what we saw in the S&P and the NASDAQ 100 here. But the Russell found the 200-day. What's interesting about that is the S&P and the NASDAQ were both below the 200-day. And so, Brent, I'm starting to wonder if there's some maybe relative strength in Russell, just simply because the potential exists for a shift in Fed chairman, and we know that a shift in Fed chairman is more likely to bring an easier monetary policy based on what the administration wants to see. So I'm wondering if there's some underlying forces maybe at play here. But speak to us about the trend. I mean, if nothing else, the move right back above the 20 days at least got small cap bulls feeling a little bit better.
Yeah, I mean, because small caps have struggled a little bit lately, and there's one is just the same thing that affects small caps affects everything. Economic uncertainty isn't good for small cap stocks. They're generally the most vulnerable stocks out there. They have higher debt levels typically, and are less financially sure footing, so to speak, just as a generality than large caps. And we also had this kind of interest rate headwind of late that has eased up just the last week, maybe. We've had a little pullback in interest rates. You can see that pullback right there. And this is the TNX. So this is the 30-year. Just move the decimal point over if you want what the actual rate is. So instead of 42, it's 4.2. But you can see it really got higher than the the level we were, hoping it kind of was about that 4.3 level, I guess, is a level that was kind of a ceiling that we had on this before. It got out of whack there, I guess, a little bit for a week or so, but now it's pulled back. I think that's helping the Russell too. But yeah, I mean, you can look at these all three. In general, you're going to expect a pretty good correlation between small caps and large caps, but small caps can often be a little bit more volatile. And so maybe we are seeing a little outperformance right now, probably helped a little bit by the interest rate picture, the monetary policy picture, which we'll see, as you mentioned, we're going to have a new Fed chair, and that on the surface at least looks like will be. And of course, the Fed chair is just the Fed chair. He alone doesn't make all the decisions, but it does bring up the prospect of kind of an easier monetary policy.
Yeah, it sure does, as opposed to the push and pull from the administration versus the Fed, which, the Fed does maintain, at least outwardly, a desire to stay apolitical and just lean into policy exclusively, not politicizing it. But that hasn't always been the case, as we all know. Now, Brent, one of the questions in the chat that I thought was really pertinent is from Rita in relation to a correlation between inflation, small cap returns. Brent, I got to say, I'm not sure if it's exclusive to inflation, but maybe a broader thought process as it relates to the margins associated with small cap companies. And there's a lot to take in there. It's not as simple as, well, inflation's rising, therefore small caps are pressured. It's even wider than that, isn't it?
It is wider than that. I mean, in inflation going up is going to tend to translate to potentially higher interest rates. Okay, because one of the factors that determines what the interest rate is one of the big factors of determining interest rate is what the expected future cost of money is, and that's inflation. And so higher expected inflation translates to higher interest rates in general, and higher interest rates tends to disproportionately affect small cap stocks. So yeah, I mean, there's probably going to be a general inverse correlation there between those two things. But as you mentioned, Kevin, it's not just small caps. I mean, it's going to affect large caps too. And so, yeah, I'm not sure if that's answering what you were asking there, Kevin, or not.
It's certainly. No, that's exactly what I was looking for. I mean, we're just trying, offering up a little bit more insight. I do think it's a number of key elements. You hit on it, right? A weakening job situation gives the Fed reason to kind of stay the course as opposed to dropping rates necessarily. We've got plenty of additional inputs that are inflationary. We know the price of oil going higher and staying higher for longer is inflationary. It puts squeezes on margins, and that's difficult for the smaller cap companies more so than the large cap companies. And again, margins are a key component to revenues and net earnings, excuse me. So those are all part and parcel of the whole process. It's very rarely, Brent, as simple as one key data point, isn't it?
Right, exactly. And just I guess to continue with what you were saying on the margin issue, when companies are in just a real solid financial situation, they can take a little bit of a hit on margins and be okay. I mean, we've seen that on some bigger companies like maybe a Walmart or things like that are in a pretty good financial situation, even when tariffs come, because they can take a little bit of it. Of course, a lot of that gets passed on to customers. But the point being, companies that are in a little bit financially weaker situation can't take a compression of margins as much. And that generally describes small cap companies.
Yes, it does. Very well said. Okay. Brent, we've looked at our biggest indices. We've looked at yields. Let's talk about the move we're getting in the semiconductors, because the snapback is exactly the kind of move we talk about in difficult markets. Big percentage moves over short-term windows of time that don't necessarily fix the trend. I think this one is a good example of that. I'm going to put it to just the 50-day moving average. But Brent, when you look at what we got yesterday, I think we had like a 5% move. And if we look at what we took from just the lows on Monday to where we are, we're up 10% from those lows in the semis. This is the kind of bear rally. I say bear rally. It is a short-term rally in a recently bearish developing market. These are the kind of rallies we get in difficult markets, isn't it?
This is the kind of rally we get, and it can fake people out. And I'm not saying it's not a genuine turnaround, but along the way, whenever you're looking at a downward trend, there's going to be periods of retracement. Is this period of retracement different than the ones we've had in the past? I mean, if you look, I don't know, it's hard for me to explain. Maybe 3 weeks ago, we had a nice big candle there. Actually, I'm going right
this
there.
One right there.
That one right there. That's a big kind of engulfing bullish engulfing candle.
Yep.
And that doesn't look that dissimilar. It was followed up the next day for the most part by it was a higher day the next day. You would probably not be, I don't know, it's reasonable to think at that point, oh, hey, we've hit the bottom, things are going to go up. And the same thing's happening now. So when we see this bounce, what's going to tell us it's different this time? If it looks different than it has in the past, then it'll be a bigger indication. But what we generally like to see is a higher high, a breaking above those previous highs. Well, our most recent high was about a week ago, and it bounced basically right off that 50-day moving average, excuse me. And that would be kind of a clear difference maker for semiconductors if we were to break above that. Until that, it's some nice momentum, and it may translate to that. And this is a necessary precursor to breaking that potential level, but it's not sufficient in itself to say that this trend has changed.
I think that's an excellent way of putting it, Brent. I'm going to speak really quickly to the look of candles like this one, where we were through the 50 intraday but closed below it. Like this one, where we had an outright doji, a close and open almost identically on a day where we tried to keep it green. Bulls tried to give a big, beautiful green candle. Didn't happen. And the day prior, same thing, Brent. Beautiful candle for a while that didn't hold, and we closed back below the 50. These are very short term, admittedly, and yet they were insightful and instructive to the trader willing to see the forest through those trees, Brent. It's been difficult in this zone around the 50-day moving average. And reminder that since we've been fighting the resistance band there, the chances are we're gonna fight it again. The question is whether there will be enough enough buyer side, right, to push us through. Can the buyers overtake the sellers at that level? And that's ultimately all we're waiting to define the potential for a new trend here. We haven't gotten it yet. Any last thoughts there, Brent?
What we'd like to see at that level is a kind of a green candle where we close near the high of the day is typically what we'd like to see, and it's definitively above that line. And it's not a guarantee that it's going to continue through at that point, but I agree with you. It seems probably a pretty decent chance if we go up there. I wouldn't be surprised at all if we bounce at that level. And it doesn't mean the bounce is going to be a full retracement back down to the 7250 level or anything like that. But at least a hesitation of some sort there, I think, would be reasonable to be expected.
I kind of like that, Brent. Had a request there from K Brown just to show the 200 day. You'll see that we remain nicely above it, but a potential rejection at the 50 day once more could give bears reason to think that the 200 could come into play once more on the semis. So if the downtrend holds or we continue to struggle, it's certainly a greater potential to visit the 200 day if we stay below the 50 day. That's just the nature of the trend. Now, Brent, I thought we should look obviously at the returns as we're getting them from the sector tool here. I'm going to kick us over to the Market Watch so that we can see the breakdown. Our biggest loser on the day is once again oil, energy, just like it was yesterday, even though it's been cruising. So we have pulled back on energy quite a bit. You know, Brent, it's not to suggest that the rally in energy is over by any stretch, but I just thought we should talk about it because one of the things that traders will look to is utilizing the weakness. If you've been waiting to play the energy space, Brent, it's this kind of a drop to a potential 20-day moving average that's been held now basically every day of this year for traders to expose money to this space in the market.
Yeah, and keep in mind, I mean, this right now is very geopolitically driven. So but it's not, even if everything resolves itself going forward with the Iran situation, oil is probably unlikely to go back to where it was 3-4 months ago quickly.
Yeah.
There's going to be lingering effects on that. But so we'll see. It is going to be susceptible to geopolitical issues. But this kind of pullback is kind of almost expected when you have something going up as fast as it has gone up, and it has gone up fast. The energy sector is really the only sector over the past month that has been in the green, and green by quite a ways too, actually, on that. But you can just see the steepness of the graph here. This is energy we're looking at right now. And when something is going up that quickly, typically you get a quick pullback. Doesn't mean it's going to go all the way back down, but that may just be kind of just a little consolidation, I guess, so to speak, before another bounce.
Well, I know I always just like to bring this to the table as a reminder. It's very much goes against human nature, but it's the red days where you're dropping to areas of support that may very well make it easier to enter those groups that you want to participate in. I know that's not easy when you see it. Your brain is trying to trick you. It says, but it's having a bad day. Why would I buy it? That's exactly the reason for consideration, is because you're off of those highs, nearer a zone of support, nearer what traders might call a decision point. Meaning if you think the 20-day that's been held year to date, every bit of it, if you think it's going to continue to hold, well, then the trader would be comfortable entering near the 20-day because a close or 2 or 3 below it would be reason to move on or maybe reduce risk. So that's why traders look for entrance near support, is because they would think, all right, if this doesn't hold, I'm going to take a very small loss. Quickly, I will react to that not holding and I'll move on. It's that comfort of entering at support because it allows them to know they're wrong quickly, thus limiting losses to small amounts. So ultimately, it's that back and forth process, Brent, that kind of, for a lot of us, we have to change our mindset a little bit about being ready to buy when the market's preparing us to be ready to buy, I should say.
Yeah, no doubt. And, Kevin brought up something in the chat. You could draw, this would be a kind of graph you may draw Fibonacci levels on too, to look for potential support. We have the one level you drew. You got the moving averages you can look at, but there's other ways you can do it. And that would include looking at Fibonacci's and seeing where they kind of line up. And sometimes, lo and behold, they end up being pretty close to where where the other potential support levels are. And that would kind of lend some strength to the narrative that it's a significant level.
Yeah, this one in particular, the 23% retracement off of the basically when oil got going in mid-December. We drew it from that originally. I also drew it from the tariff tantrum bottom as well, because you can overlay these, everybody. You can get areas of confluence from these lines that can give you more insight as well. The 23% level on, let me remove this lengthy one, just this most recent move. The reminder here, 23% does not necessarily have to hold and still maintain an uptrend. In fact, according to the Fibonacci sequencing, it's more likely that the 38, the 50, and the 61 hold up. The 23% is violated commonly. So don't assign that it has to be the first layer of potential support. The fact that it coincides with the 20-day is interesting. It might very well strengthen that level, but don't be surprised if it doesn't maintain. It would be a bigger development if it didn't hold, say, the 50% retracement. Even though 50 is not a true Fibonacci sequence or calculation, it is common to a lot of drawdowns and pullbacks when you're evaluating the move upward. And of course, as with everything in technicals, Brent, drawing Fibonacci's is an art, not a science. I just tried to select the most recent low from which we began this rally.
Yeah, I think that's the right place to start it, probably that's where I would have started it, probably. I don't know, I guess for what that's worth, to look at that. But again, this is going to be driven by oil. It's going to be driven by the Strait of Hormuz. First time I've said that today, for the first time in a while there. So that's that's all the unfortunate situation that we have right now, where we have to deal with that, and that's ultimately going to trump technical analysis, so to speak.
Yeah, I guess you didn't run the entire show without mentioning the Straits, so I guess we can cross that one off on the bingo card.
Exactly.
Brent, when you're looking at the sectors, is there one in particular that jumps out at you for having a positive day here today?
I don't know that it's a positive day today, but one sector that's interesting to me is the IT sector. And we kind of touched on it a little bit in the sense that we looked at semiconductors.
Yep.
But the IT sector, it kind of, I don't know, a little, not what I would have guessed ahead of time, was other than energy. Energy is obviously the clear standout sector over the last month. And the utilities is kind of in the same ballpark as IT, but is actually one of the better performers. Well, other than those two, was the best performing sector over the past month here. And going into it, I probably would have said, when the market as a whole is selling off, which is obviously what we've seen, IT will probably more than likely lead the way down. It tends to be a higher beta sector. And but that wasn't the case here. IT actually held up, even though you look at the chart and you go, well, it doesn't look that great, admittedly. But I'm just talking from a relative performance standpoint. It's actually holding up a little better than a lot of other sectors are. Now, just like the rest of the market, we're getting a little bit of a bounce here. We've got some moving averages. The trend hasn't changed yet with the upward momentum. We'll see on that, but I just find it interesting from that perspective.
It is interesting. We do have the crossover, the so-called death cross there, the 50-day crossing the 200 to the downside, which could mean a longer range development. We'll see. There is always the possibility, though, that we make a maneuver like this one, Brent, when we had the 50 cross the 200 here to the downside. It was pretty short-lived, and we got back above it pretty quickly. But again, that's because of big volatile moves to the downside that kick it out, right? And then eventually you get yourself right back on trend. So price action is going to dictate whether this 50-day cross of the 200 is significant for us. We'll see. But the level that stands out visually to me, Brent, is kind of right through here. And if we can find our way back through this zone, well, then we can start challenging the moving average. But we need to get above that 50-day here, everybody. You can see we've been below it since basically late January. So you've spent all of February and all of March beneath the 50-day moving average. That's getting a little bit confirmatory in nature in terms of the 50-day acting as resistance.
Yeah, and just a reminder, when we're talking about the sector level, obviously there's different components. Someone who was Dave mentioned software, which had gotten just destroyed before the software industry there. You can see how bad that is compared to, like, semiconductors or
My
a lot
goodness.
of the rest of the sector. But so, we'll see. But that may explain partially why things have IT's held up a little bit, just because software had sold off so much prior to that. By the beginning of February, it was already down so much that it actually, over the past couple months, hasn't been hit as hard as a lot of other industry groups there. And so it's not looking bullish by any means, but just a reminder that the sector as a whole doesn't mean all those industry groups within that sector are going to follow suit.
No, it doesn't, but that explains kind of the balance, right? Because we saw how great the semis were in the rally, and the software has been the exact opposite. So you've dropped 35% since mid to late October here in the software, while the semis were still rallying. So there's one end of two ends of the teeter-totter right there, Brent, in terms of technology. Software getting beaten up while semis rally. And then while semis have pulled back, you're seeing software bounce a little. Doesn't mean this is going to hold. We got a lot of work to do to get software in trend, so don't expect necessarily that to change anytime immediately. Brent, I thought we should also peek in on one of those groups that's been downright rough, has been financials. It still doesn't look like we're ready for a significant bounce here. I wanted to look here as we will rotate into to rounding the conversation with some upgrades in this space, Brent, but I wanted to give you a chance to speak to this real quick.
Yeah. So here's financials, and they've been beaten up. The trend has been down. We did peak above our 20-day moving average, so that's a good sign. Our recent highs, you can see kind of with that white line there, are probably a pretty key level with financials. Also, remember, financials kick off earnings season, and we got earnings coming up here in a couple weeks, basically, is when earnings season starts. So that could certainly help the financials, or it could hurt the financials, I guess, as well. We'll have to see what how earnings come about. But yeah, so I mean, it's kind of the same thing. All these sectors, with exception of energy, have been trending down. They're rallying, and the question is this just a temporary relief rally, or is this a genuine change, a genuine bottom? And the answer is, I think the jury's still out, it seems like.
I think that's the takeaway. We are above the 20-day for the first time since back here in early Feb, but let's again put the market to that, meaning make the market prove to you that it's back in a new trend before we start buying into it, right? That's one way to think about it. Now, guys, I'm going to give this very quickly because we are just about at time. I wanted to give you a couple of updates, upgrade details using financials, and dovetailing off of this. Wells Fargo got an upgrade today out of HSBC. They were upgraded to buy from hold with a new target at 94. That's actually reduced from 104. So heads up there. The firm's saying that markets have quickly repriced higher downside macro risk and renewed credit concerns in U.S. banking stocks. So they're basically stating that they feel like they've repriced sufficiently to validate the upgrade, and it was also an upgrade at USBC for Bank of America as well. Brent, any thoughts on the upgrades or maybe even the charts, which very much look similar, don't they?
They look pretty similar. Nice little gap up on that. And like, if you look at that Bank of America chart, you can see we had a high about a week ago or so that we're above right now. So that's a nice, that's potentially was a potential resistance. We'll see if that holds. That's a potential new support level on that. So that's a nice, strong sign there for you.
Obviously, that remains to be seen, but nonetheless, you've got an upgrade where it's reacting favorably to the upgrade. It's buying into the bullish case. We have being told early this morning. To what extent we have that continuing remains to be seen. We also should look quickly at one that got downgraded thrice, if you can believe it. That is not a good indicator. Nike was downgraded. 3 different companies hit it today, unfortunately. So Nike downgraded at JP Morgan to neutral from overweight, downgraded at Bank of America to neutral from buy, downgraded at Goldman Sachs to neutral from buy. All of these are sharing their sentiments. And, you know, Brent, the chart kind of validates it, but as usual, I'm going to complain. Why didn't we get downgrades when the company was higher in price as opposed to
it looked even worse. Go to a 5-year chart, Kevin. I know we're out of time here, but this is Nike. I mean, it's brutal. And so that's now we're getting downgrade, but anyway, it is what it is, I guess. I don't know.
Holy cow, 74% from the peak achieved in early November of 21. You're looking at 4.5-year downtrend. Yeesh. All right, we're going to have to wrap it there, everybody. Hope the discussion was helpful for you today. Thanks to Barb in the chat. It was always lively there as usual. Lots of discussion. We always appreciate that. Brent, fantastic, though, to have you back twice a week. We got lucky this week. Thanks for doing it, man.
Thanks for having me, Kevin, and look forward to do it again soon.
Absolutely. Everybody follow us on X. Hit that thumbs up button for us down below so we can get this archived and available to other attendees who don't get the opportunity to catch it live. And don't forget, be subscribed to the channel, everybody. Hope you all have a great rest of your Wednesday. We look forward to catching up with you again real soon.